Sarah bought Apple stock in 2020 for $10,000. 3 years later, she sold it for $60,000. $50,000 profit. Life-changing money. But when tax season arrived, she discovered something shocking. Her tax bill was nearly $8,000. Meanwhile, her neighbor Mark made the same profit on the same stock, but paid only $7,500 in taxes. Same gain, different tax bill. How is that possible? Welcome to the bizarre, surprising world of capital gains tax, a system where when you sell matters as much as what you sell. Capital gains tax is one of the most misunderstood parts of our tax system. Most people think it only affects the wealthy, or that it's impossibly complicated. But here's the truth. If you've ever sold a house, stock, collectible, or even cryptocurrency, you've likely triggered a capital gain. Over 60% of American households now own stocks, which means capital gains tax touches more lives than ever before. Today, we are pulling back the curtain. No jargon. No confusion. Just the real mechanics of how this tax actually works. Let's start with the foundation. A capital gain is simply the profit you make when you sell something for more than you paid for it. That something is called a capital asset, basically any property you own, whether it's stocks, bonds, real estate, or even that vintage guitar in your closet. If you bought it for $5,000 and sold it for $8,000, your capital gain is $3,000. The government taxes that $3,000 profit. That's capital gains tax. The core concept is actually simple. It's the details that get interesting. Here's where it gets crucial. Not all capital gains are taxed the same. The IRS divides them into two categories based on one factor: how long you held the asset. If you owned it for 1 year or less before selling, that's a short-term capital gain. Hold it for more than 1 year, and it becomes a long-term capital gain. This distinction isn't just paperwork. It's the difference between paying ordinary income tax rates, which can reach 37%, and preferential long-term rates that max out at 20%. One day can literally change your tax bracket. Why does the government reward patience? The policy goes back decades. The idea is to encourage long-term investment in the economy rather than short-term speculation. If everyone just flipped stocks weekly, the thinking goes, markets would be chaotic and companies wouldn't get stable capital to grow. So Congress created a tax incentive. Hold your investments longer, pay less tax. It's social engineering through the tax code. Whether it actually works as intended is debated by economists, but the rule is ironclad. Time is literally money in the capital gain system. Let's look at the actual numbers for long-term capital gains in 2024. If you're single and your taxable income is $44,625 or less, your long-term capital gains rate is 0%. Yes, 0. From $44,626 to $492,300, you pay 15%. Above that threshold, 20%. These brackets are separate from your ordinary income brackets, which makes things wonderfully complicated. A middle-class investor can often pay 0 or 15% on stock profits, while paying 22% on their salary. Short-term gains get no such mercy. They're taxed exactly like your wages, as ordinary income. That means if you're in the 24% income tax bracket and you flip a stock for a $10,000 profit after 6 months, you owe $2,400. The same gain held for 13 months would cost you just $1,500 at the 15% long-term rate. That's a $900 difference for waiting a few extra months. Day traders and frequent sellers face this constantly. It's why tax-aware investors obsess over holding periods. Meet James. He bought 200 shares of Tesla in January at $150 per share. By December, they'd climbed to $250. He wanted to lock in his $20,000 profit, but his accountant made him wait until January 2nd, just past the 1-year mark. James was annoyed. The stock could drop, he argued. But it didn't. By waiting those extra few days, his tax bill fell from $4,800 at the 24% ordinary rate to $3,000 at 15%. $1,800 saved. Patience literally paid. Here's a concept that trips people up: cost basis. It's the original value of your asset for tax purposes, what you paid, plus certain costs. If you bought 100 shares at $50 each, your basis is $5,000. Sell them for $8,000, your gain is $3,000. Simple, right? But what if you bought shares at different times and prices? What if you reinvested dividends? What if you inherited the asset? Suddenly, figuring out your true cost basis becomes an accounting puzzle. And getting it wrong means paying the wrong tax. Here's where it gets fascinating. When you inherit stocks or property, you don't inherit the original owner's cost basis. Instead, the basis steps up to the fair market value on the date of death. Grandma bought Microsoft in 1990 for $1,000. It's now worth $500,000. If she sold it, she'd owe tax on $499,000 in gains. But if you inherit it, your new basis is $500,000. Sell it immediately, and you owe zero capital gains tax. This step-up rule is one of the biggest wealth preservation tools in the tax code. Capital gains tax hits real estate too, but with a massive exception. If you sell your primary residence and you've lived there for at least 2 of the past 5 years, you can exclude up to $250,000 in gains if you're single, $500,000 if married filing jointly. This isn't a deferral, it's a complete exclusion. Buy a house for $300,000, sell it for $700,000, and as a married couple, you owe zero capital gains tax. This exclusion has quietly created wealth for millions of homeowners over decades. Consider Maria and Tony. They bought their Los Angeles home in 2015 for $600,000. In 2023, they sold it for $1.2 million. That's a $600,000 gain. Normally, that would trigger $90,000 in federal capital gains tax at 15%. But because they lived there for more than 2 years and filed jointly, the entire gain fell under the $500,000 exclusion. They paid zero federal capital gains tax. Only the extra $100,000 was taxable, costing them $15,000 instead of $90,000. The exclusion saved them $75,000. Not all capital assets get the favorable long-term rates. The IRS classifies certain items as collectibles: art, antiques, precious metals, gems, stamps, coins, even wine. Long-term gains on collectibles are taxed at a maximum of 28%, not 20%. So that rare baseball card you held for 5 years? Even though it's a long-term gain, you'll pay 28% on the profit if you're in a high bracket. The government carves out exceptions everywhere, making the system far more complex than the simple short versus long framework suggests. Now for a twist many investors miss: the net investment income tax, often called the Medicare surtax. If your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 married, you pay an additional 3.8% tax on your investment income, including capital gains. This means high earners aren't really paying 20% on long-term gains, they're paying 23.8%. It's a stealth tax added by the Affordable Care Act in 2013, and it catches many people off guard at filing time. Not every investment makes money. When you sell an asset for less than you paid, you have a capital loss. The good news? You can use those losses to offset your gains. If you made $10,000 on one stock and lost $4,000 on another, you only pay tax on the $6,000 net gain. Even better, if your losses exceed your gains, you can deduct up to $3,000 against your ordinary income each year. Unused losses carry forward indefinitely. Strategic investors harvest losses intentionally to reduce their tax bills, a practice called tax loss harvesting. Take Kevin. In December, he had $15,000 in gains from selling Amazon stock. He also held shares in a tech startup that had tanked, down $8,000 from his purchase price. He didn't want to sell. He believed in the company long term. But his advisor showed him the math. Selling would create an $8,000 loss, reducing his taxable gains to $7,000. That saved him $1,200 in taxes. Then Kevin immediately bought the startup stock back after 31 days, avoiding the wash sale rule. He lowered his tax bill and still owned the position. Smart loss harvesting in action. Speaking of which, the wash sale rule prevents exactly what it sounds like: washing away a loss for tax purposes while keeping your position. If you sell stock at a loss and buy substantially identical stock within 30 days before or after the sale, the IRS disallows the loss deduction. You have to wait 31 days. The loss isn't gone forever. It gets added to the cost basis of your new purchase, but you can't claim it immediately. This rule trips up investors who try to game the system by selling and instantly rebuying the same security. Everything we've discussed so far is federal tax. But most states levy their own capital gains taxes. California, for instance, taxes capital gains as ordinary income with rates up to 13.3%. New York tops out around 10.9%. Conversely, states like Florida, Texas, and Nevada have no state income tax at all, meaning no state capital gains tax. The difference is enormous. Sell $1 million gain in California, you might owe an extra $133,000 to the state. In Florida, zero. Geography matters tremendously. Let's bust some myths. First, the idea that only the wealthy pay capital gains tax. In reality, over half of U.S. households own stock either directly or through retirement accounts. Anyone who sells a home, inherited property, or even old collectibles can trigger capital gains. Yes, the wealthy realize more gains in absolute dollars. The top 1% accounts for a huge share of total capital gains revenue. But millions of middle-class Americans pay this tax every year when they sell assets. It's not an exclusive club. It's a widespread reality. Another common belief: capital gains tax is double taxation because corporations already paid tax on their earnings. Here's the reality. Corporate income tax is paid by the corporation on its profits. When you sell stock for a gain, you're being taxed on the increase in the stock's value, which may or may not reflect corporate earnings. If you bought low and sold high, that gain is yours, not the corporation's. Dividends can arguably be double taxed, but capital gains are a separate transaction. You're taxed once, on your personal profit from a sale. It's not double taxation, it's taxation of your individual gain. Not everything you invest in qualifies for capital gains treatment. Certain investments, like interest from bonds or savings accounts, are taxed as ordinary income, not capital gains, even if you hold them long term. Cryptocurrency is treated as property, so gains are subject to capital gains tax, but the rules are evolving and complex. Commodities futures, options, and some derivatives follow special rules. Even real estate investment trusts distribute income that's often taxed as ordinary income rather than capital gains. The type of investment fundamentally changes the tax treatment. Always know what you're buying from a tax perspective. Here's the biggest exception to everything we've discussed: retirement accounts. Inside a traditional IRA or 401k, you can buy and sell stocks all day long, racking up huge gains, and you owe zero capital gains tax. None. The gains grow tax-deferred until you withdraw the money in retirement, and then it's all taxed as ordinary income. Roth IRAs are even better. Gains grow completely tax-free and withdrawals in retirement are tax-free too. This is why financial advisors push retirement accounts so hard. They're capital gains tax shelters, allowing compound growth without the annual tax drag. Even outside retirement accounts, deferring capital gains can be powerful. The longer you hold an asset without selling, the longer you defer the tax. That money stays invested and keeps growing. This is the difference between active trading and buy and hold investing from a tax perspective. Frequent traders pay taxes every year, reducing their capital available to reinvest. Long-term holders defer taxes for decades, allowing compound growth on money that would otherwise have gone to the IRS. Over 30 years, the difference can be staggering, often hundreds of thousands of dollars for the same gross returns. Compare two investors, each starting with $100,000. Investor A actively trades, earning 10% annually but triggering short-term gains taxed at 24% each year. Investor B buys index funds, earns the same 10%, but holds for 30 years, paying 15% long-term capital gains only at the end. After 3 decades, Investor A has about $740,000. Investor B has over $1.4 million. Same returns, wildly different outcomes. The tax drag from annual realization costs Investor A over $600,000. That's the hidden cost of frequent trading. Here's an obscure but powerful rule. Section 1022, Qualified Small Business Stock. If you buy original issue stock in a qualifying small C corporation and hold it for more than 5 years, you can exclude up to 100% of your capital gains, capped at the greater of $10 million or 10 times your basis. This was designed to encourage investment in startups. Early employees and angel investors use this to shelter enormous gains. It's complex and has strict requirements, but for those who qualify, It's one of the most generous capital gains breaks in the entire tax code. In real estate, there's another powerful deferral tool, the 1031 exchange. If you sell investment property and reinvest the proceeds into similar property within strict timelines, you can defer all capital gains tax. Investors use this to pyramid wealth, trading up from property to property over decades without ever paying the tax. The gains compound, tax deferred, potentially for life. When you die, your heirs get the stepped-up basis, and the deferred tax disappears entirely. It's a strategy the wealthy use routinely to build real estate empires while deferring taxes indefinitely. Cryptocurrency has introduced new wrinkles. The IRS treats crypto as property, meaning every sale triggers capital gains. But here's the catch. Even trading one crypto for another is a taxable event. Swap Bitcoin for Ethereum? That's a sale of Bitcoin, and you owe tax on any gain. Thousands of day traders making dozens of swaps face a compliance nightmare, often owing taxes they didn't realize existed. Many exchanges don't provide clear tax reporting, leaving investors to reconstruct their basis and gains manually. It's a mess, and many crypto investors are sitting on undisclosed tax liabilities. Here's the genuine aha: capital gains tax isn't just a revenue mechanism, it's a behavior design system. The government uses it to nudge you toward long-term thinking, home ownership, retirement saving, and startup investment. Every rate, exclusion, and holding period is a lever to shape economic behavior. The 0% bracket encourages middle-income investing. The primary residence exclusion promotes home ownership. The 1031 exchange fuels real estate development. Qualified small business stock spurs entrepreneurship. Once you see this, the entire structure makes sense. It's social engineering disguised as tax policy, and understanding the incentives lets you align your decisions with the tax advantages. Armed with this knowledge, the first strategy is tax location, putting the right investments in the right accounts. High turnover assets like actively managed funds go in tax-deferred accounts where trading won't trigger annual capital gains. Buy and hold index funds and individual stocks go in taxable accounts where you can control realization and benefit from long-term rates and the step-up at death. Bonds and rights, which generate ordinary income, also belong in tax-deferred accounts. This simple placement strategy can save tens of thousands over a lifetime without changing your actual investments. It's just smarter organization. Second strategy, active gain management. In years when your income is unusually low, say you're between jobs or took a sabbatical, consider realizing some gains. If you drop into the 0% capital gains bracket, you can sell appreciated assets, pay no tax, and immediately rebuy them at the higher basis. This is called gain harvesting, and it resets your cost basis upward with zero tax cost. Conversely, in high-income years, defer gains and harvest losses. The key is treating capital gains realization as a controllable variable, not a random event. You decide when to trigger the tax. Third strategy, charitable giving and family gifting of appreciated assets. If you donate stock that's doubled in value to charity, you get a deduction for the full current value and avoid paying capital gains tax on the appreciation. Win-win. Similarly, gifting appreciated stock to children or grandchildren in lower tax brackets lets the family realize the gain at their lower rate. You can gift up to $18,000 per person per year in 2024 without gift tax. Smart families use this to shift gains from high bracket seniors to low bracket juniors, cutting the overall family tax bill dramatically. Fourth, time asset sales around major life events. Retiring? Your income drops, potentially moving you into a lower capital gains bracket. That's the year to realize gains. Getting married? Combining incomes might push you into a higher bracket. Defer gains until after you file separately one last time, or wait until the next year when planning can optimize the marriage penalty or bonus. Selling a business? Spread the sale over multiple years if possible to avoid a single massive spike. Life events create tax planning windows. The savvy investor thinks 3 years ahead, not 3 months. None of this works without meticulous records. You must track every purchase price, date, reinvested dividend, stock split, and corporate action. Brokers report sales to the IRS, but basis tracking is often your responsibility, especially for older accounts or inherited assets. One missing record can cost you thousands in overpaid taxes or, worse, trigger an audit. Use portfolio tracking software. Keep annual statements forever. Document gifts and inheritances with appraisals. The burden is on you to prove your basis. Treat record keeping as seriously as the investment itself. It's not exciting, but it's essential. Capital gains tax complexity quickly exceeds most people's comfort level. If you have multiple asset types, rental properties, business interests, or six-figure plus portfolios, hiring a CPA or tax advisor pays for itself. They'll spot opportunities you'd miss: loss harvesting, bracket management, entity structuring. They'll also keep you compliant, avoiding penalties and interest. A good advisor doesn't cost money. They make you money by minimizing taxes legally. Interview several, ask about their experience with capital gains, and ensure they're proactive, not just reactive at filing time. The right help is an investment, not an expense. Tax policy never stays still. Capital gains rates and rules change with each administration and Congress. There have been proposals to tax unrealized gains for the ultra-wealthy, eliminate the step-up basis, raise long-term rates, or broaden the net investment income tax. Any of these could reshape the landscape. Stay informed. Subscribe to reputable tax news. Review your strategy annually. What works today may not work in 5 years. But the core principles, deferral, managing realization, using exclusions, keeping records, will remain valuable regardless of rate changes. Adaptability is your hedge against future uncertainty. Let's talk psychology. Many investors hold losing positions too long to avoid admitting a mistake, and sell winners too quickly to lock in a gain. This is exactly backward from a tax perspective. You should harvest losses to offset gains and let winners run to defer taxes and qualify for long-term rates. The emotional pull is powerful, but costly. Recognize it. Separate investment decisions from tax decisions, but then integrate them. A good investment held slightly longer for tax treatment is often the optimal move. Don't let pride or fear override smart tax planning. Zoom out. Over a lifetime, capital gains tax is one of the largest drags on wealth accumulation outside of retirement accounts. But it's also one of the most controllable. Unlike income tax, where your salary dictates the rate, you control when and how you realize gains. You choose the holding period. You decide which accounts to use. You manage losses. This control is rare in the tax code. Exercising it intelligently can mean the difference between a comfortable retirement and a wealthy one. Small, consistent tax-aware decisions compound just like investment returns. Over 30 or 40 years, the edge is massive. So what's your next step? First, pull up your brokerage statements and note your unrealized gains and losses. Identify positions you've held less than a year versus more than a year. Second, check your income projection for this year. Are you in a low bracket where 0% long-term gains apply? Third, review your asset location. Are high turnover funds sitting in taxable accounts generating unnecessary tax? Fourth, set a reminder to revisit this every December. Year-end tax planning is when most opportunities appear. Finally, if your situation is complex, schedule a consultation with a tax professional before year-end. These 5 actions take an afternoon and can save thousands. Here's the uplifting truth. Capital gains tax, despite its reputation, is actually one of the fairer parts of the tax system. You only pay when you profit. You pay less if you're patient. You pay nothing in retirement accounts. You get huge breaks on your home. There are escape hatches for losses, charitable giving, and family transfers. Yes, it's complex. Yes, it requires attention. But the rules, once understood, are workable and even advantageous if you plan. You're not powerless. You have agency. And that agency, applied consistently over time, builds wealth and security. That's the real story of capital gains tax. Capital gains tax isn't a trap, it's a system. And like any system, those who understand it gain an advantage. The holding period matters. The account type matters. The timing matters. Records matter. Strategy matters. But above all, awareness matters. Most people pay more capital gains tax than they should simply because they don't know the rules. Now you do. You know about the 0% bracket, the primary residence exclusion, the step-up basis, loss harvesting, and the power of deferral. You've seen the real examples. You understand the myths and the opportunities. That knowledge is leverage. Use it. Your future self and your bank account will thank you.